With inflation rates nearing 5% in the US and just over 3% in Canada, one of the most common questions I get asked is, what do you do to prepare for higher interest rates? Well, if you believe interest rates are going to go up, you should probably have a plan. Even if you don't believe that interest rates are going to go up, you should probably have a plan. And today I'm going to give you that plan and give you 3 things that you need to do to prepare for higher interest rates if and when they happen. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where one lucky subscriber is going to win $5,000 to put towards their mortgage, maybe a down payment, maybe use it for savings, or simply to pay off other debt. It's up to the subscriber, but in order to win, you have to be subscribed. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit, product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss what you should do to plan for higher interest rates. And a lot of the discussion today is going to be around habits and smart financial planning and making sure that you actually have a plan for the eventual reality of interest rates going up, especially if you are really concerned about interest rates going up. So I'm going to walk you through the steps that I would take today in order to plan for higher interest rates. But first, I want to start by showing you what it would look like if interest rates did go up by a certain amount. So I'm going to dive into our online mortgage app, or this is actually our app that you can get for Android and Apple iPhones. And I'll put a link in the description below, but this will allow you to go ahead and figure out what your payment would look like at different amounts. So this is just a simple mortgage calculator. You click into it, you go ahead, put your mortgage amount in, you put in your interest rate, and you put in your amortization. For most people, it's going to be about 25 years. And then what you can do is you can go ahead and start playing around with the interest rates here. So we're going to start at 1.4%. And we're just going to see what happens if we would change the interest rate to different amounts. So let's say we assume that interest rates were going to go up by about 1%, or that's what we were going to plan for. We would take this, type in 2.4%. And that tells us that our payments go from about $1,980 up to about $2,200. So about a $200 increase. And then if we were going to suggest that they might go up by 2%, well, then we see that they go up to $2,476, so about a $400 increase. So what we're basically gathering from this information is how much we need to plan for in case interest rates go up. And what you'll find is that if interest rates were to go up 1 or 2%, it would have a pretty considerable effect on people's finances, which is a lot of the reason why it's not expected that they're going to go up significantly when they do start to go up. Because if we saw the entire country all of a sudden have 25% higher payments, that would lead to a pretty big financial crisis for most people. So the rise in interest rates will probably be long and slow just for that reason alone. So if we start to think about it and we go, okay, we have a $500,000 mortgage, and if interest rates go up by 2%, that's going to increase my payments by about $400 or $500. Well, what can I do now to start planning for those eventual rate increases? And there's a bunch of really simple things that you can and should do. And I'm going to go through and talk about those in great detail right now. So first and foremost, if you are worried about a 2% increase in interest rates or a 3% increase in interest rates, and you have a car payment, well, the reality of it is your car payment is likely higher than the increase in interest rates that you're going to feel over the next couple of years. So the first thing you can go ahead and do to prepare for higher interest rates is get rid of any car loans, get rid of any lease payments, get rid of any other sorts of debt, and that will put you in a very, very good position when it comes to your finances should interest rates start to increase. And this is the one thing that I tell my staff, I tell my clients, is if there's one thing that you want to make sure you do to get more financially stable, it's get rid of your car loans. Whether that means paying them out because you have the cash, or whether it means selling a high value vehicle that has a big loan and buying something that's cheaper, that has maybe had a few miles put on it, but is going to be significantly cheaper to drive because you aren't going to have to worry about those payments. And by the way, keep in mind, the biggest fear people have about used cars is that they're going to have a repair that needs to be made that isn't under warranty. Well, think of it this way. If you have an $800 a month car payment and that costs you basically $9,600 a year, it's going to be very, very, very hard to find a repair on a vehicle that's a used vehicle that's going to cost that amount of money. So regardless of what you do, there's a really, really good chance that you're going to be far better off by not having a car payment, even if you have to maintain a vehicle outside of warranty. So this is the number one thing we tell people is if you're worried about rising interest rates, if you're worried about things happening in the economy, and you're worried about your ability to survive, then get rid of those car loans. And if you want to drive a really nice car somewhere down the road, don't go and buy it today. Take the 5 or 6 years that you would have had that car financed anyways, save the $600 or $700 a month, put it in a savings account, let it grow, and then buy the car cash when you have the opportunity. That is probably the best piece of financial advice that I can give people. And I tell you what, when it comes to people who have struggles with their finances, and we see this on a regular basis, the number one thing that they don't want to give up is that car loan, and it would be the quickest and fastest way for people to get back on their feet if they just didn't have that payment obligation. So my first recommendation, if you are fearful of rising interest rates, is get rid of the car loan first. That's the first and foremost thing that you can do to set up your finances better. The second thing is set up an automated savings plan. So think about this, okay? If you're worried about interest rates increasing over the next few years, and you know that your expectation is that you're gonna have a $500 higher payment a couple years down the road, well then go ahead and start setting aside $500 per month right now, and just get it going into a savings plan so that when interest rates do start to go up, you have that money to fall back on if you need it. And you've also gotten used to having that much money coming out of your account. Now, the easiest way to do this is to have it go to a bank or an account that you don't easily have access to in your everyday banking. So maybe you have a bank account at another bank. Maybe you have it at a place like Tangerine where you aren't necessarily going in and looking at it every day, and you just automatically have the money coming out of the account that your paycheck goes into and into that other account that's set aside for emergencies and is there for basically having that ability to have the money come out of your account and get you used to having higher payments and less cash flow for down the road. And if you want to improve on this idea, go ahead and make sure you get a variable rate mortgage. Take that extra $2,500 to $3,000 a month that you're saving by having a variable instead of a fixed, and take that and put that into your savings account as well, so that when the time comes, if it comes, and by the way, I'm not suggesting that interest rates are going to go up, because as an economist, I've studied this sort of thing, and I know that when interest rates get low, interest rate sensitivity is quite high, and it takes a long time for interest rates to increase. But if they do, at least you know that you've got that money set aside and you haven't given it to the bank in the form of a fixed mortgage that you're going to pay a premium for and have to pay a higher payment for anyways. Now, the third thing, and this leads into the type of mortgage you should be selecting, is if you believe that interest rates are going to go up and you're concerned about it, you want to make sure that you have a flexible mortgage. And this means avoiding things like the 5-year fixed. And the reason why is even though a 5-year fixed might keep you at a lower payment for longer, you're basically just delaying the inevitable. And if interest rates don't go up, you're basically paying too much for your mortgage. But the big thing about a 5-year fixed is that they have an IRD penalty typically. And what that means is that you could end up in a scenario where you're going to have a really big penalty should you have to pay out that mortgage. And in the event that you have a payment that is too big, you can't afford to make it, and you need to sell that property, the fastest way to lose a bunch of money on a house is to have to give a whole bunch of equity to the bank in the form of a penalty. So what you want to do is you want to keep your mortgage flexible. Highly recommend 1, 2, 3-year mortgages or variable rate mortgages, whichever are the cheapest you can get at the time. Get the one that has the lowest interest rate where you're able to save more money, put it in your savings account for that rainy day that may come down the road, and just make sure that you've got a low penalty mortgage so that in the event that you have to sell, you're easily able to do it. Because I can tell you right now, what will likely happen is if interest rates do go up and there are people that need to sell, there's going to be a lot of people underwater, not because the values of the properties have gone down, but because they have an excessively high penalty that basically eats up a whole bunch of their equity. And by the way, if you're selling because you get into financial difficulty, you probably need to have the equity to pay off your other loans and your other debt. And if you're giving a whole bunch of it to the bank in the form of a penalty, guess what? not a good idea. So keep in mind that when you're getting a fixed rate mortgage, you're paying a premium for having a locked in rate. You're also paying a premium to get out of it in the form of a higher penalty down the road, and you're losing your flexibility. So that's why we recommend taking variable rate mortgages right now. And if interest rates do start looking like they're going to go up very fast and in a very quick manner, then we may start looking at locking in variable rate mortgages. But for right now, we can lock in the savings by having a lower interest rate, and that gives us the opportunity to create a savings that will basically operate as a backstop against any sort of higher interest rates, inflation, and any sort of potential financial issues that we have down the road. So if there's one thing that I can leave you and have you take away from this video, it's this. Do everything you can in your power to create a savings plan that makes it so you have less payments like car loans and leases, so that you have money going into a rainy day fund and investments for somewhere down the road, and get used to living a lifestyle that is based on a significantly higher interest payment than what you are paying right now. And if you can do those things, you are very much going to be secure from any form of rising interest rates down the road, and you will be able to make sure that you can weather all storms, good or bad. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. If you want to know all about how to get a lower interest rate, there's a link in the description below to our Secrets to Getting the Lowest Interest Rate course. And if not, we'll see you on the next video anyways. Cheers.